Welcome back to Investing Talk Podcast.
Today we're looking at Akari Therapeutics.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're examining a clinical stage biopharmaceutical company, and they are focused pretty much entirely on the bleeding edge of oncology treatments.
Right, specifically that class of drugs called antibody-drug conjugates, or ADCs.
Exactly, ADCs. And Akari is deep in the R&D phase, which, is completely standard for a biotech with this kind of profile.
So that means they're pre-revenue?
Yep, zero commercial revenue.
Yeah.
And because they are just pouring capital into developing their pipeline, they have deeply negative earnings per share.
It's the classic setup. Massive risk, but potentially a massive reward. And it's all tied to the success of one or two key drugs.
And that really sets the stage for what we need to focus on. When you look at any pre-revenue company, especially in this sector, the income statement it's almost irrelevant right now.
The negative EPS just reflects the cost of innovation.
Right. So we have to look past the top and bottom line and ask two fundamental questions.
What's the tech they have that nobody else does?
And do they have the financial stamina to actually prove that technology works?
Exactly. The technology is the engine, and the cash runway is the fuel. It all comes down to intellectual property and balance sheet strength.
Okay, so let's unpack that first piece. The technology.
Right. With a pre-revenue biotech, it's always about the proprietary advantage, what analysts call the moat.
What's fascinating here is that their advantage isn't just in the antibody, the smart bomb part of the ADC.
It's in the payload.
It's in the payload, the poison the bomb delivers. They use a proprietary spliceosome modulating payload, specifically designated as PH1. This is the core differentiator.
I want to pause on that term, spliceosome modulating payload, because it sounds like pure medical jargon, but it's critical. For our listeners, what does targeting the spliceosome actually achieve?
Okay, so think of the cancer cell as a faulty factory that's rapidly churning out bad proteins that let it survive and multiply. The cell's instructions for making those proteins are encoded in its RNA. The spliceosome is the essential machine inside the cell that processes and edits those RNA instructions.
So it's like the cell's quality control department.
Pretty much. And most traditional ADC payloads are like standard explosives. They just damage the cancer cell's DNA. Akari's PH1 payload is different.
Oh, so?
It's more like a targeted molecular wrench that specifically sabotages the spliceosome machine itself. It corrupts the cell's internal operating system,
Forcing it to make flawed, toxic proteins.
which causes the cancer cell to basically commit suicide. It's a crucial distinction. They aren't just making another version of an existing drug. They're trying to fundamentally change how the cancer cell dies.
And their intellectual property protects this whole process.
Precisely. That IP is what positions them against, much larger competitors. The whole point of using PH1 is to get better efficacy, especially in those really stubborn resistant tumors.
And this leads us straight to their target, which is where the market opportunity gets, it gets truly stark.
They're specifically focusing their next-gen candidate, AKTX 101, on some of the absolute hardest to treat cancers.
Most notably, KRAS mutant pancreatic cancer.
Right, which has notoriously poor survival rates.
Yeah.
And when you add that KRAS mutant marker, you're talking about one of oncology's most intractable problems historically.
For decades, KRAS was considered undruggable.
It was. It acts like a perpetual on switch for cell growth, and it's found in about 90% of pancreatic cancers. The challenge is just immense.
So if the preclinical data on AKTX 101 translates even partially into the clinic, that would be a game changer.
It would address a massive critical gap in cancer treatment. The market isn't just large, it's desperate.
Okay, so the tech is highly differentiated, the target market is huge, but as we said, excitement needs funding.
This is the critical pivot point. Their free cash flow is negative. That's a given. And their balance sheet showed pretty limited cash reserves leading up to the recent announcements.
However, a few months ago, we saw some significant activity on the financing side.
They completed a registered direct offering and a private placement, raising approximately $5 million.
Now, $5 million in the world of big pharma R&D, that can sound like a drop in the bucket.
It can. That's a legitimate concern.
Hmm.
But what stands out here is the insider participation.
That's the key.
Directors and executives injected over $1 million of their own new cash into the company as part of this raise.
That's a serious vote of confidence. When management is willing to open their own wallets for a seven-figure sum at these levels, it suggests they believe the company is significantly undervalued.
They aren't just selling the story, they're buying the stock.
And that insider alignment, plus a debt-to-warrant conversion that cleaned up their balance sheet, extends their liquidity runway.
Right. And the big question is, how far does that runway extend?
The projections put it into late 2026, maybe early 2027.
And that timeline isn't arbitrary. It aligns directly with the projected timeline for initiation of clinical testing for their lead asset, AKTX 101.
So they raised just enough money, backed by strong internal conviction, to bridge them to the next critical de-risking milestone.
Exactly. That $5 million isn't just a random number. It's a strategic bridge to a major inflection point.
Which brings us to the market reaction and the technical picture. If the tech is this promising and management is buying in, why has the stock been under such intense pressure?
It's been battered. We're talking a massive decline, about 75% over the past year. The 52-week range is huge, from around 21 cents up to $1.73.
This is not a stock for the faint of heart.
No. And that decline reflects two things: the inherent risk of preclinical biotech and the near-term dilution that always comes with financing rounds.
But the technical suggests that pain might already be priced in.
I'd say so. We've seen classic oversold conditions. The relative strength index, the RSI, is sitting extremely low, around 23.
And for anyone less familiar, an RSI below 30 is typically seen as oversold. What does that signal psychologically?
It signals the stock may have been driven down too aggressively, maybe beyond what the fundamentals warrant. Think of it like a rubber band that's been stretched too far.
Creating a setup for a potential rebound.
Or at least an accumulation phase. Savvy traders might view this current level as an attractive entry point, betting that the dilution risk is now fully baked into the price.
And analysts seem to agree that the reward could be incredibly asymmetric here. The current consensus price target implies a huge upside potential.
Over 346%. And we've even seen individual analyst reiterations reaching as high as $5 a share.
So they believe a breakout could materialize once momentum builds.
They're essentially saying the current price does not reflect the underlying value of the PH1 platform.
Okay, so novel technology, strong insider confidence, a clear financial runway, and deeply oversold technicals. It's a very bullish picture. But we have to talk about the bear case. What keeps the price grounded?
The primary bear case is the binary nature of drug development. You've got two major buckets of risk: scientific and financial.
Scientifically, it all comes down to clinical failure.
Right. The inherent risk of major delays or outright failure for AKTX 101 is paramount. We have great preclinical data, but what works in a petri dish?
Often fails in humans.
Exactly. If that preclinical success doesn't translate, the entire investment thesis just evaporates. The market is pricing in that possibility of failure.
And then there's the financial risk. That $5 million gets them to 2026. But what if a trial is more expensive than planned?
That pushes them into the second financial risk, which is more dilution pressure. They're also being monitored for Nasdaq compliance on their minimum bid price.
Which adds another layer of pressure.
It does. If they need more capital before late 2026, they have to go back to the markets, meaning more dilution.
And the competitive landscape here is crowded.
Yeah, absolutely. While Akari's PH1 payload is unique, the target, KRAS, is a massive focus for the entire industry. They're betting their ADC approach will succeed where others have struggled, but a breakthrough by a larger competitor is a constant threat.
So what drives volatility between now and that big 2026 milestone?
It'll be driven by incremental pipeline updates. Investors will be hanging on every piece of preclinical data. Regulatory items like Nasdaq compliance will also cause price swings.
But there's also a broader macro trend that might actually favor a high-risk play like this.
Tell us about that.
Well, we're seeing a sector rotation favoring oversold small caps. As anticipation builds for future rate cuts, capital is slowly flowing back into these development stage oncology plays.
Because lower rates make those far-off future cash flows more valuable today.
Exactly. And Akari, with its deep discount, fits that oversold small-cap oncology profile perfectly.
So ultimately, the entire investment thesis just rests on this being a profoundly asymmetric risk-reward scenario.
That's the core bull case. You have highly oversold technicals, backed by powerful insider conviction and a secured cash runway. It's a binary bet on scientific success, but it's a bet backed by the people running the company.
So Akari presents a classic high-risk, high-reward biotech play. You need to be monitoring this over the next year for those incremental updates, but also watching if the broader biotech rotation starts to lift these names.
The combination of proprietary tech, solid insider alignment, and a deeply discounted price point creates a compelling, albeit volatile narrative.
And if they manage to hit their targets for AKTX 101, the potential return could fundamentally justify the extreme risk you're taking on at this stage.
Don't forget to subscribe to the show to keep up with all our latest analyses. We'll catch you next time.